Valued investors, stocks finished the first half of the year the same way they started, with solid gains. Strong rallies from big tech names, combined with somewhat softer economic and inflation data, helped propel the S&P 500 to its seventh monthly gain in the past 8 months and set dozens of new record highs along the way. Over the past week, we closed the books on a strong first half for the stock market and celebrated America's 248th birthday. I hope everyone enjoyed some R&R with family and friends. But America isn't the only birthday we're celebrating in July. The Federal Reserve's pausing of interest rate hikes turns 1 year old. The Fed's last rate hike came on July 23, 2023. Fed pauses, whether rate hikes or cuts, have generally been good for stocks, especially the longer ones, with gains for the S&P 500 lasting about 8 months in 5 of the last 6 pauses. In what is currently the second longest pause since the 1970s, the S&P 500 is up about 20%, very close to the 22% gain seen during the longest pause in 2006 through 2007. This means the current bull market has already captured the average historical gain for year 2 of a bull market, a few months before its 2-year mark on October 12th. So what might the second half of 2024 have in store for stocks? If history is a guide, then more gains are possible, as strong first halves have historically been followed by above average second half returns of about 6%. When first half gains were 10% or greater, the index averaged a 7.7% advance in the second half. S&P 500 companies in aggregate are expected to deliver double-digit earnings growth in the upcoming second quarter earnings season, which may offer near-term support for stock prices, particularly the AI beneficiaries. However, bull markets are not linear, and pullbacks or a correction should be expected in the second half. Political and geopolitical risks are rising. The AI trade could begin to consolidate or even fizzle. Inflation data, including the Fed's preferred measurements, have cooperated of late, but that could reverse and push yields up again. Furthermore, the market's advance has been quite narrow. In fact, technology and internet stocks have driven 70% of the year-to-date advance, with about 30% of it coming from NVIDIA alone. That is a big gap to fill in a possible tech correction or sell-off. Rotating into more attractively valued areas of the market, potentially industrials, financials, or energy, might help limit the downside, but that is no sure thing. What we are more confident in is the probability of success towards your long-term goals when you stick to a financial plan and dollar cost average into equities over time. I hope everyone is having a safe and a fun summer so far. And again, happy birthday, America. Stay safe and stay the course.